Yeah, so Buffett says that I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. So there is clearly an interplay and advantage on those. One of the things that happens in with entrepreneurs or CEOs who are running specific businesses is they have two things going on. One is usually their circle of competence is limited to that business. So if they're in the hotel business, they understand the hotel business. If they're in the shipping business, they understand the shipping business. And that competence can be an advantage because if they understand the movie business in China, they probably have a better shot at understanding the movie business in the US than a person who's not in the business at all. So the domain knowledge is a huge advantage. The disadvantage normally that strategic investors have is they may not understand, or they may not have a good understanding of value investing. So, like for example, a lot of companies buy back their own stock. Now, if you're in the hotel business, it means you understand the hotel business, which should mean that you should understand when it is undervalued and when it is overvalued. Most company CEOs are not really good at understanding when their businesses are under and overvalued. And one of the reasons they don't understand that is because if you are going to be a great leader, you have to be an optimist and you have to be a builder. And so you always see the grass is green on the other side. And value investors are always skeptical. They're always looking for what is wrong. One of the reasons I sold all these companies much sooner than I should have is because I'm always skeptical about what might go wrong, for example. And so there are different skill sets. So if you have some data which tells you that the CEO of the film company in China is a good capital allocator, then that can be a huge tailwind. If you have some data that tells you that. So the thing that you have to evaluate is, are they good capital allocator? Then those are rare. So for example, obviously Warren Buffett is really good at buying companies. John Malone is really good at buying companies. Sam Zell is really good at buying companies. But lots of, the Japanese came into the US markets in the 1980s and they bought all kinds of real estate, trophy real estate all over the country, and they grossly overpaid for it because they looked at their experience in Japan where these properties were much more valuable because they were in a bubble. So they misunderstood what proper valuations were, and they didn't do well, even though they understood real estate in their own country. So I think that it's a good idea to follow the strategic investors into other markets if you can figure out whether or not they are value guys. They understand value. Like for example, the deal for Starwood. So I forget the name of the Chinese company, it was the insurance company that was chasing Starwood. And Starwood is a very prime asset. It's a great asset. But I don't know enough to know whether that would or would not have been a good deal for them. They were clearly paying up significantly more than what the market had priced that company. So you would have to have an understanding of how those people think and whether they think correctly.